So I'm sure by now most of you must have already caught up with the most recent banking crisis, which all started from Silvergate Capital, which collapsed due to crypto crashing in the past 12 to 24 months, and that collapse quickly cascaded to Silicon Valley Bank (SVB) and later on Signature Bank. Yes, you heard that right, 3 banks in a row, 3 US banks with a total market cap of around $12 billion collectively just ceased operation in the span of just 1 week. But that's not the only damage, because collectively the US banks lost close to $200 billion in terms of market value due to fear and loss of confidence. But before I talk about what you can expect in the near future, here's a little recap to give you a better picture of the entire saga. You see, in normal day-to-day banking, we put our money into the banks and ask the bank to help us keep it safe, and in return the banks will pay us a small and tiny savings yield. Simple stuff, right? But because banks are also profit-driven companies, they can't just sit on a huge pile of cash from all of us and do nothing about it. So what they do is they take some of the cash deposits and then invest them into low-risk investments like US Treasury bonds that pays them higher yield. So for example, if the bonds are paying them 2% yield but they are paying us 0.5% of saving interest, then effectively they still have a net interest margin of 1.5%, right? That margin is one of the many ways the banks make money, of course, aside from giving out loans and offering credit card service and whatnot. But let's not go over there today. The point I'm trying to make here is smaller banks like the just collapsed SVB and also Signature Bank, they were more aggressive in generating a larger margin to generate more profit for themselves. So what do? They invest in a bunch of long-term bonds that pay a pretty decent yield back in 2020 and 2021 when interest rates were near zero. But little did they know, the inflation hit us like a truck, and very quickly the Fed had to raise about 4.75% of interest rates within the span of 12 months. And because of that, the prices of long-term bonds crash. And guess what happens if you hold a lot of long-term bonds? Well, you effectively sit on a bunch of toxic assets that are worth much lesser today in terms of market value. Just to give you a sense of it, SVB sat on about $200 billion worth of assets, which give them about 1.64% per annum of interest rate. A huge contrast to the long-term bond today that pays about 3.6 to 3.8% per annum of yield. And to make things worse, those assets were locked away for more than 10 years like a fixed deposit. So imagine how bad that bet went, because they basically went all in and YOLO'd into long-term bonds in hope of the Fed maintaining the low rate environment for a long time. But of course, that didn't work out. And because SVB served mainly larger sized clients in the form of tech startups and venture capital firms, which is actually a small community of founders and investors which talk to each other pretty much every other day, the fear of a bank run spread very quickly like wildfire, and startups left and right were withdrawing money from the bank, and SVB were forced to sell away some of their toxic assets, aka those underwater long-term bonds, to raise cash just to stay afloat. And that cycle kept repeating, and the news quickly spread towards other banks as well. So the regulators had no choice but to step in, and the first one being the US FDIC, the US Federal Deposit Insurance Corporation, which basically came in and said, "Ooh, calm down people, we have insured your money up to $250,000, so don't worry, you will get your money back." But if you think about it, 250,000 does sound a lot to you and I, but that is actually a small amount to startups and venture capital firms. So there were a lot of noise and FUD, basically fear, uncertainties and doubt, spread by those people on Twitter and social media that the US banks are all collapsing. And guess what the average consumers did? They started lining up outside of the banks to withdraw money from their regional banks in fear of them collapsing as well. And that fear and panic eventually went out of control, and the Fed members had to quickly come up with an emergency meeting on a Sunday and introduce the BTFP program, short for Bank Term Funding Program, not to be confused with Buy the Effing Dip. And yeah, what a bad name, right? But when I take a guess, when was the last time the Fed had to get up for an emergency meeting on a beautiful Sunday? Well, the answer is during March 2020 when the pandemic started. Hopefully that tells you how much panic there was in the market. So back to this BTFP program, it's essentially a short-term loan facility of up to 1 year that allows the banks to collateralize their high-quality assets to the Federal Reserve in exchange for a loan at par value of the assets with a total backstop amount of $25 billion. And to make it simple for you, remember the SVB story I just shared with you where they had a bunch of long-term bonds that are basically underwater now, right? Yeah, just imagine that. SVB bought those long-term bonds at say $100 back then in 2020, but today it is worth only say $50. But because their bank needs cash because people are withdrawing, right? If they sell it today, they essentially net a loss of $50, right? Well, not anymore, because here comes Papa Jerome Powell that says if you let him hold your bonds, then he will essentially give you a loan worth $100, which is the par value of the bonds. So suddenly everyone regained confidence because technically no banks can fail now, or should I say no smaller banks can fail now. They can just pledge all their toxic asset to the BTFP program and essentially get cheap money. Well, not entirely free because you still need to pay a cost of about 4 to 5% interest in today's term. So the possibility of a bank run is minimized already, or at least for now. And if it's not obvious already, when you pledge a toxic asset that is worth so little in exchange of money from the Fed at par value, i.e. the full value, and then you default in paying back the loan, guess what the Fed is going to do? Well, they are just going to take away the toxic assets and say, okay, no problemos, it's a fair trade since my money is free anyway. So take a guess where the free money comes from. I hope that explains. And before we move on, here's a quick word for the sponsor of this video, Momo, a brokerage platform that provides you advanced charting tools, analysis, and smart indicators for you to identify stock price trends easily and faster, both on their mobile app as well as their desktop trading platform. You can also easily sort out stocks with their stock screener, which comes with over 100 indicators, and also check out stock portfolios from famous funds such as Warren Buffett's Berkshire Hathaway and so many more. Feel free to use my affiliate link down below to get free $10 cash coupon, and if you deposit more than 2.7k Sing dollar, you will also receive up to 1 Apple stock, which could be worth around $150 per share. And if you are watching this from the US, you can also use my link down below to win up to 15 free stocks. Thank you Momo for sponsoring this video. Okay, let's get back to business. So what happens now that the dust sort of settles down for SVB? What are the impacts that you and I can expect in the near future from the SVB crisis, as well as from the implementation of the BTFP program? Well, the very immediate benefit, if it's not obvious already, is stopping the spread of fear, because fear can easily cause bank runs, and that will spiral out of control very quickly, just like what happened with Lehman Brothers and Bear Stearns back in 2008. What happens from now onwards becomes very important to all of us, because banks will be even more risk averse in giving out loans. And on top of that, I think it's pretty safe to assume central banks all over the world will start coming up with more stringent regulations, which could come in the form of, say, higher regulatory reserve requirement, which is like the cash cushion for banks, or lower limit on certain investments the banks can make and whatnot. Possibilities are endless, but one thing is for sure, it will all lead to a reduction of profit margin to the banks, and at the end of the day, that will definitely trickle down to us consumers in the form of higher cost of borrowing. But pessimism aside, the BTFP program could just be the beginning of a new quantitative easing cycle, which means more money is being printed and more liquidity is being injected into the market. And you all know what happens afterwards. Asset prices and stock prices will go up if that's the case. JP Morgan analysts are now estimating that the new program could see the Fed injecting up to a maximum of $2 trillion worth of liquidity into the market, but realistically, they actually predict it based on the amount of uninsured deposit at 6 US banks, and that's about $460 billion. So that's about $500 billion to a maximum of $2 trillion. It's still a pretty significant amount if that flows into the market. So now there are two liquidity facilities that the banks can borrow money from if they run into any sort of trouble. Firstly, the BTFP program that I've just explained to you, and secondly, the older and much more traditional facility that they call it the discount window. It's basically just like BTFP, functions like BTFP but has been around since forever, but banks generally try to avoid borrowing money from it because usually any banks that requires money from the discount window would raise a huge red flag. So guess what? The latest data reported by Bloomberg showed that in the week ending 15th of March 2023, a total of $165 billion have been borrowed from the two facilities I've just mentioned to you. Only a small $11.9 billion was utilized from the BTFP program, while the remaining $142.8 billion was borrowed from the discount window, an all-time high number. The prior week's borrowing was only $4.58 billion, and the highest recorded borrowing was only $111 billion recorded back in 2008 during the subprime mortgage crisis. So can you grasp the magnitude of additional liquidity being pumped into the market? But if there's anything we can learn from history, is that the crisis doesn't just start and end there. In fact, it will usually spread to other industries over time. It could be in the form of liquidity crisis where people don't trust the banks anymore or not as much as before already, and then they will just withdraw everything or just leave a minimum amount below the insured threshold. Then banks wouldn't have enough cash to lend out, and if there's not enough financing capability, then projects left and right or mega projects wouldn't be able to proceed, and broad economy will definitely slow down because of that. And that is of course the worst case scenario, but there is always one way to stop all of this from spiraling out of control. You guessed it. But all said and done, hopefully this video was able to get you up to speed with what's happening so that you understand the stock market or heck the general economy better, and that will definitely make you a better investor. I hope you enjoyed this video. Do follow my Instagram for the latest updates in real time. Links are all down below. Thanks for watching, and as usual, I will see you in the next one.